Hi, this is Mike Maloney. I had this chart in a recent report where I was reporting on an accident waiting to happen on the COMEX. But the report I'm doing now is more about, is there or is there not some major emergency out there in the global economy that's potentially being covered up? That, when you learn about emergencies, when Lehman Brothers happened and when the global meltdown was happening, you learned about it after all of that had happened. When Bear Stearns went under, I mean, you learn about these things the day after they've been having all of these meetings all night long, trying to figure out how to patch up the global economy. Well, recently I reported that the levels of registered gold on the commodities exchange have dropped to these record lows, and there's only a couple of reasons that there would be. So the HSBC and Scotia Makata mostly taking all of this gold out of the registered category for sale on the COMEX for delivery into futures contracts. And one of the reasons is that they might believe that there is something up, that there's something wrong with in the global economy, and that they want this gold as insurance. And so now I'm going to get into, I really can't explain to you what is going on with the capital account at the Federal Reserve. But if you look at this, this goes back into 2003, and the moves here are usually very small. This is the 2008 financial crisis. And then suddenly we've got this move from almost 60 billion down to 40 billion, so a $20 billion move. And this is their capital surplus. And again, this is from 29 billion to 10 billion. So it's just a huge drop. The point of all this is that there was a day recently where the Fed suddenly needed $20 billion for something. That currency went somewhere. And they needed $20 billion that already existed. They couldn't manufacture $20 billion. Normally, what the Fed does is they buy an asset or they create a loan. Those are the two ways, and the loan is basically an asset from then on. But those are the two ways that they create currency. And they could not do that. Whatever this $20 billion was used for, they couldn't do it in the normal methods. They had to take it from their capital account. So this is highly unusual, and it says that something is up. Something just cost the Fed $20 billion, and they could not create the currency to cover that $20 billion. They had to withdraw it from their capital account of dollars that already existed. This is just to show you how broken the world economy has been since the crisis of 2008. This is U.S. government deposits at the Federal Reserve. And since the crisis of 2008, they've exploded, but look at what has happened in just the past month here. Something is up. This is reserve balances that the banks have with the Federal Reserve. So these are the balances that the commercial banks do all of their fractional reserve lending off of. And look at what has happened here. So the amount of deposits that the commercial banks have at the Federal Reserve has suddenly collapsed. And then this is retail money funds. Now, retail money funds and money markets, this is, if you've got a brokerage account, you've either got your currency tied up in the stock market, invested in stocks or bonds or something like that, or you've got it in a cash account. And that cash account, they usually call it a sweep account or something. It's put into retail money funds where they invest in treasuries and then it'll pay interest. And there's a couple of reasons that this will rise and a couple of reasons that it will fall. Sometimes it falls because people just have less currency. They're not as wealthy as they were. But then it'll also fall when the stock market starts to go up and everybody is attracted into the stock market. And so they'll take their currency out of the money funds and they'll put it into the stock market instead. But it also rises during crises. And, this is a very long-term view going back to 1980. I'm going to zoom up now to just this century. So here's from the year 2000. And what you see here is the response to 9/11. people got scared and they moved out of stocks and into retail money funds. This is Lehman Brothers. This is probably Bear Stearns. This is the Greek crises. And suddenly, just recently, we have everybody moving out of stocks and into retail money funds here. This is a scary chart. I mean, look at the size of the Lehman Brothers. This is the global meltdown of 2008, and we got the same thing happening now. This is IRA and Keogh accounts. And there's nothing wrong with this chart other than the numbers. So we've got these potential emergencies happening. I've said time after time that every 2 to 9 years there's a recession, these gray bars. And the recessions usually cause the stock market to either go flat or fall or crash. And the only problem with this chart, I mean, people are putting away currency for retirement, and that's probably a good thing. But this stops at about $650 billion. The problem is there's about 65 million baby boomers about to retire. That's only $10,000 per person. This is a disaster waiting to happen. Thank you I wish I had better news. I don't. Thank you very much. We'll see you in the next video.